So I wanted to ask you how you value some company that doesn't really they don't really have much. They don't have cash flow. Like maybe they've drilled or maybe not even drilled. And some of them right now have some results, but not much. Like they don't have a resource or reserve. So how do you stick an amount to something like that? To be able to yeah.
I do a very back of the envelope model, understanding I'm not going to get it right, but I'm going to get it more right than somebody who doesn't do a model at all. And so I will, and I don't want to name any companies, but let's say that there is a company that has a deposit somewhere in Africa, as an example. And I believe that the target size, they haven't proved it yet, but the target size, a reasonable target size, given the superficial extent of the alteration and the data that's happened from trenches and drill holes. Let's say that I believe that the target size is 100 million pounds. And let's say that I have an opinion as to grade. I try to construct an economic model around what it would cost to build that mine, what the mine would likely see as all-in production costs, what the cash flow would be given the time value of money, which is to say, if production starts 6 years from now, I discount it back at their cost of capital. And I try to decide the net present value, the indicated net present value of that deposit. And then I try and assign a probability as to whether, how likely it is that I'm right. And if, let's say just for fun that I have a expected discounted net present value of $350 million. And let's say that the market capitalization of that company is $60 or $70 million. I can make that work in my own mind. The probability is I'm going to be wrong, but the probability is small enough that I'm willing to take the chance so that I can play to the upside. If by contrast, my expected net present value is $300 million and the market cap of the company is already $180 million, they have to raise, $50 or $60 million to stay alive for 5 years. They have to raise $300 million to buy the mine, of which $100 million is equity, which is to say dilution. Why would I take a $300 million improbable bet for $180 million on the long side? I have no interest in that sort of outcome.
That's the companies that already have something in the ground. What about the crapshoots?
The crapshoot's fairly easy for me. Let's say that there's a $20 million company that has a concept. The first thing I look to in that circumstance is my downside. If I was to take that exploration thesis in that ground, and I was going to go to attempt to joint venture that to somebody who knew what they were doing, say a Cameco or a China General Nuclear or a NextGen or a Denison, could I get them to spend $20 million on an exploration joint venture to own 50% of the property? In other words, what is it worth? If the answer to that is no, if the liquidation value of that concept is $1 million and they have a $20 million market cap, that means I have a current probabilistic downside of $19 million on a $20 million bet. What's my upside? You follow what I'm saying?
Absolutely.
The second thing I look at is absolutely the track record of the people involved in the company. Because an exploration company is not built around an asset. It's built around human resources. It's an intellectual property business. It's the ability of the management team to understand the exploration thesis, and not an exploration thesis that's built on what's convenient for them in terms of raising money, but rather an investment thesis that has been ground truthed, based on data. And if the management team that's promoting the $20 million drill hole play doesn't have a lot of intellectual capital, proven intellectual capital in that business, I don't mean that they've successfully found a nickel mine, by the way. I mean that they have experience in uranium, and experience in uranium in approximately the same geological setting as the setting that they're in. I don't have any interest whatsoever. I mean, I have less than no interest. It's as though you assigned somebody whose background is software algorithms to do biochemical research on a molecule that might cure cancer. Why on earth would you assign a complex topic to somebody who has no experience in the sector? What's the probability of success with that misapplication of human resource?
I absolutely understand that, because I recently spoke to uranium geologist who happens to be the CEO of my personal biggest speculation right now. And we did sort of a uranium exploration masterclass where he took me from idea to how do you make a sellable project. It was a good 1.5 hour conversation. But so he told me the story of uranium discovery that happened in Africa, where they were drilling, or they were taking some grab samples, and one of the geologists sat down to eat their lunch, and noticed an anthill, and the ants were carrying small pieces of stone that had some green thing on them. And so he picked it up, started researching it, and they poked a hole or a couple of holes, and they found a massive deposit that ended up getting sold, and it was a big success story. But you got to have the team that's able to do that. You got to have the geologist who's got the eye to do that, who's looking around and thinking about these things. Because if you have somebody who's never done it, they're going to be eating their lunch. They're going to get up and maybe never find it.
That's a very good point. If you, as an example, are looking in Africa, and you have field geologists who've worked in Africa, they look for anthills rather than having to dig. The ants and the termites have already done the digging for you. And there have probably been 10 or 15,000 anthills or termite hills in West Africa that have been sampled for precisely that reason. You can do a broad-based survey more cheaply. Now, somebody whose experience is Northern Canada or Kazakhstan won't think about the fact that a lazy man's way to survey in Africa is anthills and termite hills. That goes right exactly to local knowledge. So it's a very good story that you bring up. Very instructive.
Yep, I thought so too. Anyways, moving on from the exploration side of the story, though, I know that those are generally not your favorites in terms of risk reward right now. You've mentioned a couple of times, by the way, that Kazatomprom was one of your favorites, because I also believe that I believe that you describe yourself to as a risk analyst. So I was just wondering, from a risk perspective, are you still of the same opinion that Kazatomprom offers the best risk reward?
Yes. Yeah, absolutely. I'm not a narrative investor. People are very afraid of countries they can't spell or pronounce. I've gotten lots of criticism by way of saying that Kazatomprom can't import inputs or export uranium because of Russia. Absolutely untrue. Absolutely untrue. I'm not trying to say that there aren't political risks in Kazakhstan, but in my life, I've learned that I would rather take political risk than technical risk. I've made money in Sudan. I've made money in Syria. I've made money in Congo. I've lost money in California. I've lost money in France. I've lost money in Canada. That isn't to say that I haven't had good experiences in countries that are believed to be politically secure. What I am saying is that tier one deposits, really, really, really high quality deposits, are where you find them. And you seldom find them in places that have been explored for 100 years where people are comfortable. You find them in places like Kazakhstan. I would much rather take the political risk than the technical risk. I would much rather own the lowest cost producer in the world's most well-endowed country than I would own a marginal asset where success is improbable in my own side yard.
And I think that if Adolf Landin were alive, he would definitely agree with that. That's how
Adolf
he made his fortune.
Adolf taught me that.
Okay.
Adolf said deposits are where you find them. Most people look for deposits that wouldn't be stolen by the host government simply because they weren't worth stealing. Adolf learned, first of all, that a country that can't get worse often gets better, and a country that can't get better often gets worse. But most importantly, Adolf learned that deposits are where you find them. I was taught by an earlier mentor than Adolf that in exploration, you make money by employing old ideas in new places or new ideas in old places, but you don't employ old ideas in old places because that assumes that you're smarter than all the people who've come before you in the last 100 years. And that isn't probable.
Yeah. Or it assumes that you have a promotional company that's only going to be around for 2-3 years.
And, you know, the idea that you're going to invest in a promotional company where the promoter assigned himself or herself a bunch of stock at a penny, and now they're trying to get you to buy some stock at 50 cents. The promotion's already occurred. Could it go to $1? Could it go to $1.50? Yeah, sure. Anything's possible. You know, the tooth fairy might come visit you and give you 100 euros for a tooth. Or you might be walking down the street at home and, you know, 3 supermodels from Victoria's Secret might invite you away for a long weekend. But what are the chances?
Just for the record, if my wife ever listens to my videos, I would never do that. I definitely sell my teeth to the tooth fairy, but I've got fake teeth, so she wouldn't buy it. But yeah. Anyways, when we talk about these sort of out of favor countries, I'm also trying to figure out where sentiment comes in your style of investment. The sentiment on a stock, or the sentiment on a whole market, or the sentiment in a whole country. Like, do you ever pay attention to that or go off the sentiment while deploying capital, Rick?
I mean, I believe that sentiment's a fantastic negative indicator. What I'm interested in is the delta between the value of something and its price. If something is out of favor and it's selling for a quarter of its value, which is to say the sentiment is negative, but the reality is great, I buy it. If the sentiment's great and the value is lousy, I don't buy it. And if I happen to own it from an earlier movie, I sell it. That's precisely what happened to me in the Uranium Juniors. The butchers and the bakers and the candlestick makers, which is to say the flotsam and jetsam of the uranium business, was free 3.5 years ago. And there were some good people inhabiting that space. The delta between perception and reality was on the side of reality. And so I bought a bunch of stock. Fast forward, and all those penny dreadfuls were up 3 or 4 or 500%, which is to say that the perception had marched a lot, but the reality was unchanged. And so I sold them.
Is there something else besides intuition to do that? Because you have the experience to show for it. But if I want to use some sort of a more objective sentiment geek, what do I do?
I mean, I don't know how to implement the task that you've assigned me. You're a journalist. You would likely be better at understanding the impact of a story on a market, at understanding the near-term impact of sentiment. I'm a credit analyst, which is to say a pawnbroker. So my background goes to value and probabilistic outcomes. There is no part of what I do on the long side that assigns a value to sentiment. You can get price action out of sentiment, but value doesn't change. And what I'm interested in, to reiterate, is the delta between value and price.
Exactly.
Either long or short.